as we rolled into this year, it felt like we knew kind of like the short to middle term direction of the Fed. All signs were pointing towards rates dropping. A lot has happened since. GC, how would you summarize kind of like what's going on at the Fed these days?
I think everybody, including the Fed, is hoping and wishing and praying for the Fed funds rate to drop so that the borrowing costs for the rest of the economy would go down. And we um, just been disappointed. It just hasn't happened. So I think the Fed's in a tough spot. There's just a lot of variables that we didn't know about towards the end
Yeah.
of last year or the beginning of this year, where we were all putting our thoughts together on where rates would be. And I don't think, it's clearly the Fed didn't know either. And what's noteworthy here is the signals that the Fed is making today are affecting your properties today. They're affecting your interest rates on your mortgages. And so, what the Fed actually does when it comes to either raising rates or lowering rates or whatever, if you're going based on that to understand how this is affecting your rental property, it's too late. The time to understand how it's affecting your rental property is like right now when they start to make some signals and some shifts. That's
Mm.
how it really works. So, I think if we're all hoping that rates were going to come down sooner and faster, we've been a little disappointed, like I mentioned. And we looked at why have rates been higher? Well, it's at the end of the day, it comes down to inflation. Inflation and the job market has been stronger than we have expected, especially over the last few months. So when inflation's higher and the job market's stronger, that ultimately tends to lead to a higher Fed funds rate,
Mhm.
which is the rate that the Fed charges or banks charge each other for overnight borrowing. And then that in turn raises the rates of everything else, like
Mhm.
10-year treasuries and then mortgages. So if we could just solve this inflation problem,
Mhm.
everybody's thinking, oh man, well, then we can have rates come down. Well, one of the biggest drivers of the inflation problem was the lack of oil that was traveling largely through the Strait of Hormuz because of the war in Iran.
Mhm.
And costs of a barrel of oil skyrocketed. They were way high. So, but if you look at the news over the last like weekish, week and a half, the cost of oil has actually gone down. But what's noteworthy here is that our mortgage rates have not gone down. In fact, they've gone up a little bit recently. So when I was looking at this, I'm like, oh no, what's going on here? Why is this happening? We were all hoping when we started to see some potentially positive news with the end of the war in Iran and starting to see oil flow potentially a little bit more and the cost of oil going down, that would lead to lower mortgage rates. But it didn't happen. And so I wanted to just kind of share kind of like a cool like nugget thing to help, finance nerds like myself kind of understand this a little bit more. And that's really where we can get to the dot plots. And this is a good segue into this dot plot thing. Okay. So what I'm showing you is a dot plot, and these are all the dots that represent what the Fed presidents believe the Fed funds rate will be in the future. And this is actually a really big deal because when the Fed's presidents, who are the decision-making body of what the Fed funds rate is, when they start to think that the Fed funds rate is higher in the future than it is today, what that signals to the market is that we should expect rate increases, Fed funds rate increases. And the flip side is also true. When the Fed presidents say, hey, I project that the Fed funds rate will be lower in the future, well, then the market takes notice because the market believes that there will be rate decreases in the
Mhm.
future. And so it was really telling between the meeting in March and the meeting in June. Yeah, let's go to this meeting in March first. Because in March, you can see our Fed funds rate was 3.625% with a target range between 3.5 and 3.75. If that's your benchmark, then if you looked at the dot plot and the median projection for what the Fed funds rate was going to be based on the people who were making that decision, looking into the future, the median projection was 3.4. So we were at 3.625, and the people who are making the decisions are signaling that rates are likely to be 3.4 back in March. That's when everybody thought rates would be lower because you got the people who are making the decision saying, hey, this is what I project later in 2026. But then something shifted just a couple of weeks ago when it came to the June meeting here. And this is the reason why rates did not go down, even though oil costs went down, and rates have actually gone up a little bit. It's because they poll and survey those presidents after the meeting that they had in June 17th, and the median projection for 2026 rates had risen from 3.4 to 3.8. And 3.8 is higher than 3.625. So now the market is on notice, and every other investor out there is looking at this who makes some investment that is a variation of the Fed funds rate. And they're saying, oh, geez, I see higher rates coming in the future. And so the way that this relates to us as rental properties investors is what happens when the Fed projects higher median, has a higher rate projection, immediately bonds have a higher rate. So the 10-year treasury yield tends to go up. And when the 10-year treasury yield goes up, our long-term mortgage rates go up. And so that's what's happened here. So even as oil has gone down because of the dot plot of these Fed presidents and their projection that rates are likely going to be higher the rest of this year, that is the reason that our mortgage rates are higher today than they even were a couple of weeks ago, 3 weeks ago, when oil was a lot more expensive. I think this is fun for me to like learn, and I hope it's fun for you all to learn a little bit more. But I don't think this really has an effect on your plan. If you're using this information to say whether this is the right time to buy or the wrong time to buy, you're missing the point. Because number one, as we've seen in a 2 month span, the Fed presidents might have a different projection next time, and mortgage rates might go down for a
Yeah.
period of time.
Yeah.
But, or the opposite may happen. They might go up. At the end of the day, your plan for when it comes to rental properties is built on a full market cycle. And if you looked over those dot plots and you looked into the longer run, every one of those dot plots in the long run was like at least 1% lower than what it is today. So long term, I think everybody is pretty sure that there will be some rate relief, but even if it's not, just focus on acquiring assets. Focus on getting assets in your portfolio. The reality is that most clients refinance their properties 3 years or 5 years into them owning it anyways to be able to harvest the equity that comes out of it so they can acquire more assets and have more, what do we call them, Pablo?
Property babies.
Have more property babies. So don't get so focused on what the rate is today. I love this stuff. So I'm always focusing on, understanding it because it's good to know and I want to teach you all. But like don't let this take an otherwise excellent plan that you have and stop your momentum. There are a lot of people that don't subscribe to what we believe here in the Not Your Average Investor show and do sit on the sidelines and wait for that interest rate drop to happen. That's the way that people normally make decisions. And so there's a ton of people that are sitting on the sidelines here in Jacksonville that are saying to themselves, well, I want to buy right now. I've been wanting to buy for the last 3 years, but I'm going to wait for that interest rate to be 6% or 5.5%. And when that happens, which it will happen at some point, you're going to see those buyers come off the sidelines in droves. And what's going to happen is we're going to have higher than normal home price appreciation on the other side of this. So just like Michael Santorios was talking about when he bought his properties, I think he mentioned it was at like a 10% interest rate. The easiest thing to predict is that when interest rates come down, home prices go up. It happens almost every single time. So if we're buying at an interest rate right now that is higher than we all want, and we believe because the Fed presidents have dot plotted it out in the future that we think rates are going to be lower, what you're likely to see is you're able to capture some home price appreciation simply because rates are coming down, and that's going to bring a lot of buyers off the sideline. That's going to be more demand for housing and more home price appreciation in your overall rental property portfolio.